chance that you'll end up paying less in lifetime taxes. Now, for me, I've always been a big math person. And so when I was presented with the idea of saving for retirement in a 401k or a tax deferred account and saving for retirement in a tax free account, my brain instantly went to the math, right? How much taxes are we talking about? Knowing that could help me to make a decision. So you may have to calculate the numbers for yourself. You may have to calculate, how much am I really saving each year by deferring my taxes until later? And how much will I pay each year when I go to take that money out to spend it to support my lifestyle when I'm no longer working? Now, we chose an example. Obviously, this is not your example, but it is designed to illustrate the point. We chose an example of a couple making about $150,000 a year, and they're saving 10% of their money for their retirement. So that's about $15,000 a year. Now, the IRS will give them a tax credit or tax reduction, should I say, not tax credit, tax reduction of $3,300. So that's how much they save each year, right? So they're probably excited that they're saving that $3,000. If you multiply that out over a 30-year time frame, they're saving about $99,000. That's how much they saved in lifetime taxes. Now, what happens when they now enter retirement and they decide that they want to live off of their savings?
So let's say their goal is to have, we'll just say maybe 115, 120,000, somewhere in that ballpark. Let's say that's the amount of money that they want to have when they stop working. And so if they desire to have about $115,000 worth of income, how much will they be required to pay in taxes? Well, each year, they'll be required to pay about $10,291 in taxes. In 10 years, they will have paid $102,000 in taxes. In 20 years, they will have paid $205,000 in taxes. And in 30 years, they would have paid $308,000 in taxes. And this is not even including the amount of state taxes that they would pay.
Do you see the point? Right? They're paying more in lifetime taxes just to defer paying taxes right now. But it gets worse than that. What if they don't want to lower their income? What if they want to keep their income where it is? Well, they'd have to pay more taxes. What if a mate passes away and they are still required to take money out of these tax deferred accounts? That's called required minimum distribution. The government says it has never been taxed, so you need to take a certain amount every year. Well, because they're no longer married and they're in a single tax bracket, they're going to have to pay more money in taxes. What if they have an emergency expense and they need to take out a large sum? What if there's a long-term incident or long-term care incident that requires them to access their money quickly? And what if taxes themselves go up? See, all of these different scenarios could cause them to pay more in lifetime taxes when they stop working.